situation and we see some opportunity, I think the Class A, the nicer, the better the deal, the more sticky the cap rate is going to be. I think on the lower end of the spectrum, that's where the cap rates will widen out, and that potentially can impair your ability to return your money, basically.
That was Michael Becker. He's a principal at SPI Advisory. Keep listening for investment strategies from someone that specializes in complex. The limited partner shares in the potentially outsized returns of a well-planned and executed investment, but as a passive investor, and has the maximum leverage on their most precious asset, their time. And that is why we're here together. 90% of the millionaires out there built their net worth with real estate. However, 0% of the billionaires are hands-on managing their real estate assets because there simply isn't enough time. My name is Jake Wiley, and for the past 16 years, I've been investing in real estate, and I've learned a thing or two. But the most important lesson is how to leverage the expertise and time of others to maximize your investment potential. Welcome to the Limited Partner Podcast. Well, all right, partners, welcome. This week, I'm joined by Michael Becker. So he is the principal at SPI Advisory. Michael, thank you so much for being here on the show.
I appreciate you having me. Thanks so much.
Well, I guess, Michael, to kind of set the stage for everybody, if you wouldn't mind, if you give a little bit of background. I know you've been with SPI for a while, but let's go back in time. Let's learn about you and what you guys do.
Sure, yeah. So Michael Becker, I'm based here in Dallas, Texas, run a company called SPI Advisory with my partner, Sean. We have two offices. So I head up our Dallas office. My partner's in Austin. So we focus on Dallas, Fort Worth, Austin, San Antonio, so kind of three of the four majors in Texas. We're not big fans of Houston, so I'll let the next guy buy Houston. But prior to we started buying apartments in about 2013. So what are we 9 years into this thing now? Prior to that, I worked as a commercial real estate lender for a long time. Worked for a regional bank. Wells Fargo bought my bank, so spent several years, nearly a decade in the loaning on multifamily and really all commercial real estate asset classes. In the last, say 4 or 5 years of my banking career, I focused on, doing a bridge product, basically coming out of the Great Recession, all the defunct deals from, I guess, what are we, like 14 years ago now? I can't believe it's been 14 years, but 13, 14 years ago, all those broken deals, I was making loans kind of to fix kind of Humpty Dumpty, put it back together. And kind of through that process, realized I was on the wrong side of all those deals. And that's kind of when I went out and started our company. So we've done 12 to 13,000 units over the last 9 years. We own about 7,000 or so today. Kind of went from workforce housing and it's kind of scaled up into kind of Class A to Class A minus. So generally speaking, 20 years or younger is kind of what most of our portfolio consists of today. So it's been a heck of a good run,
That is a great run. Are you mostly based out of Texas? Is that where most of your assets are?
Yeah, so we're only in Dallas, Fort Worth, Austin, San Antonio. So only the three of the four majors in Texas. That's kind of we are considering expanding out of state, but we've chosen to kind of keep it pretty tight. And the three markets that we're in have pretty large unit count. So there's about about 1.4 million multifamily market rate apartment units across the three markets. So there's quite a bit of opportunity. It's quite a bit of transactional volume. So there's lots of pitches to look at, but eventually we'll expand out of state. It's not quite yet.
Yeah, Texas is definitely one of the larger states. Sure. Here in South Carolina, we have to be a little bit more thoughtful in terms of our geography. But I think probably the southeast of the U.S. is probably equivalent to Texas in that regard.
Yeah.
But I guess as we think about it, you've seen a lot since 2013. I am sure this past year has been exceptional. What gets you excited about the current market, what you're doing and what you're seeing these days?
I think here we are kind of in the second quarter of 2022. And, with the last 12 months have been just an absolute on fire from both operational standpoints as well as kind of the investment sales market as well. I mean, what world would we think that we're going to see, 14, 15% average annualized rent growth? I mean, in a normal year, if we hit 3%, we're happy. So here we are, 5x what a year that would make me happy. And as we kind of go into the best part of the leasing season right now, which is really from about March through July or so in Texas. I mean, we're just kind of towards the front end of the leasing season, so haven't seen any slow up in rental rate increases. So that's extremely exciting to kind of see all the 7,000 plus units that we own today. I mean, all generally speaking are participating in that. So that's real exciting. I mean, kind of on the flip side, what's exciting, maybe not the best way, is we're seeing some inflationary pressures on our expenses from it's kind of the stuff that we have seen inflationary expenses for the last few years, which are your taxes, your insurance, and your payroll. So in Texas, property taxes are a lot bigger deal than some of the other places where it's kind of more capped. And like Arizona, I know, for example, and Georgia are a lot more muted than say Texas on their real estate taxes. So that's a little bit of a headwind that we have here in Texas. And then you're seeing short-term interest rates start going up as well. So we're seeing a rising interest rate environment. So everything's always changing. So it's making the debt a little bit harder. Where a few months ago or 6 months ago, the debt was easy, great rental rate inflation, and we hadn't seen expenses really pop up yet. So 6 months ago it was all gas, and now you're seeing a couple breaks kind of coming in along the way. So just trying to stay on top of that and making sure we're doing the proper thing for the various investments that we're in. So just trying to stay on top of everything is kind of exciting.
I mean, there's some great points, right? I was at the Best Ever conference a couple weeks back, or maybe a month or so back now, and there's still a lot of enthusiasm about the multifamily market. Rent growth. I think people looking to do deals. But there was a little bit of an undertone of some skepticism about the things that you mentioned, like rates increasing, also inflation, and really just finding the right people. I guess as you look at the market, how are you changing the way you diligence, the way you're looking at deals? What looks like a good deal for you in this kind of current market where we're starting to see a pivot?
It's just everything's just tough now with the debt. The debt market's really what shifted. Say the last, year to date, 2022 has really kind of shifted. In particular, when February kind of got here, it really started changing, because that's when the Fed, if you go back to the fourth quarter of 2021, they were a lot more dovish, and then they got extremely hawkish on the pace of the short-term interest rates going up, trying to tame inflation. So that's, if you look at the forward SOFR curve, which SOFR is secured overnight funding rate, which is what a lot of these loans are priced of. That's the index that took over from LIBOR. So you see the forward SOFR curve steepen dramatically. So if you put that in your underwriting model, you're going to pay materially higher interest rates than you would have a few months back. So that's making these deals a little tighter. And then when the lenders are sizing these things, is making them even that much more tighter, because the investment sales market's still been hot. We haven't seen any real appreciable pullback in pricing. So you're paying record pricing, and your rates aren't record lows anymore. They're starting to kind of bump up. So it's making these deals extremely tight. So that's the biggest kind of challenge, is trying to, how do you figure that out? And then one of the things we should probably talk about too is a lot of these loans have been put on with bridge debt has been kind of one of the more prevalent things in the marketplace last maybe 18 months or so. And when you get a bridge loan, you need to typically be required to purchase an interest rate cap. So it's a cap on SOFR. So if SOFR can't go over a certain strike price, so it means strike rate, meaning that if SOFR today is 25 basis points or 0.25%, lender will say, okay, you can never make SOFR go over 2.5%. So if it goes up 2.25%, the cap, you buy a cap for a certain amount of costs, and that'll artificially cap it there, and they'll pay you the difference if it goes above that. Where if you go back a few months ago, these interest rate caps are really, really inexpensive. And now with the SOFR curve steepening, expectations are rising, these caps are like exploding. The cost of the caps are exploding. So it's, dramatically more expensive to purchase a cap. So that's another little headwind, because it's more money up front that you got to deal with, one. And then two, typically if you have a 10-year loan or 5-year loan, you buy a 2 to 3 year cap. The lender makes you escrow money, then you got to repurchase the cap after 2 or 3 years, whenever it expires. And looking forward, the amount that all these lenders have been escrowing for the borrowers have been woefully short relative to current expectations of pricing. So there's a couple ticking time bombs out there with some of these existing syndications. If it's a floating rate loan, that has an interest rate cap that maybe people aren't quite fully up to speed on. That if you're a limited partner, you should start asking your sponsors questions like that. What are they thinking about if they have to reset the cap in a year or two? How much have you escrowed? What's the current cost of that cap, and what's your plan to make up the shortfall? Because usually you don't have a couple, depending on the size of the deal, several $100,000 to several $1 million kind of just laying around to buy these rate caps.
Yeah, that's a really interesting point. I think one of the other things you brought up about the cost going up for the debt, right? And when you think about how these projects are factored, right? It's based on cap rates, which is based on NOI, and NOI is not taking. I was in this argument with somebody earlier today about this. Like the NOI is not taking into consideration your debt, right? And then the cap rates haven't really adjusted yet, so like you do see that pressure that's kind of coming where it's like, yeah, like the debt's really putting a lot of pressure on these deals because it's not adjusting out on the other side yet. But I guess in terms of opportunity, I always look for like, where's the opportunity? And I think you were hinting at it, is that there are a lot of deals out there where probably folks are getting ready to have to refinance, or the debt's coming due, or their term is coming due, and it's going to create some issues. Do you see opportunity there? Like, what are your thoughts on that?
Yeah, I haven't seen a ton of dislocation yet in the marketplace. It's all's good so far. However, I've been thinking there might be some dislocation at some point in the market, but 15-20% rent growth covers up a lot of issues. So as long as the demand fundamentals are strong, it might just kind of get a lot of stop the dislocation on the marketplace. Now, with that said, if there is going to be some dislocation or some opportunity, I think it's largely going to be in more of the workforce housing space. Specifically, you got these people who took some debt fund mortgages, which are 3-year mortgages that had floating rate adjustable rate mortgages on them, that had the rate caps, and they had to go in and implement a certain value add strategy and then sell it to the next guy and the next guy. Because it's been kind of the path we've been on the last 10 to 12 years, is the value add 2.0, 3.0, 4.0. And if the ability to refinance out of these deals aren't there, because the sizing rate on your lender's going to do on a mortgage isn't, your net operating income isn't sufficient to exit at your current principal balance, there could be a couple, people that are forced to sell instead of refinancing. And then if interest rates are up, maybe that might be the point where we see some cap rate expansion, which we have not seen yet. But I can kind of see in the future a little bit that's certainly a possibility. But I've thought that a few times in the past 10 years, and it's never happened. So I've clearly reserved the right to be wrong. But I think if there will be some level of opportunity distress, I think it's largely in the workforce housing, largely in the people that took the debt fund bridge loan option, and they're all floating adjustable, and they come due in the next 12 to 18 months. Those are probably where you see some dislocation in the marketplace.
Yeah, and in the workforce housing, I thought that was an interesting point. I was actually talking with a lender yesterday. It was even on Sunday, asking, just kind of talking about where do we think the pressure is going to come from, right? And from a workforce perspective, it's really the blue collar folks that are getting squeezed by these rent increases pretty hard, right? Because the hourly rates are not keeping up with these rent increases that are coming across the board, and the rent increases are real. So in terms of your thoughts on that, what is kind of the outlook, and what should we be looking for in the marketplace? Is workforce housing something that we should really be keeping our eye on?
Yeah, I think so. We started. That's where we started. That's where, when I was a banker, that's predominantly what I lent on. And you've seen some real wage increases, but you've seen everything's costing more. So the lower end of the range, as you mentioned, when gas and rent and food and everything they buy, the necessities of life are going up, is eating up a larger percentage of their disposable income, essentially. Fortunately, we're pretty high up in the priority rank, being multifamily investors, that they'll prioritize rent over other things. Generally speaking, so we're at least in preference from investment standpoint. But you're seeing the rise of the syndicators out there. I'm a good example of it. I've been doing it longer than most, but 9 years in the business, and I have a podcast. You have a podcast. All these podcast. The awareness of the space is great. So you're getting some later entrance into the marketplace that may or may not be fully seasoned and sophisticated, taking in some capital and maybe not thinking through risk mitigation, because the last 2 years they've been aware of the space. It just only goes up. So they maybe aren't quite thinking of some of the boogeymen around the corner. And I've been thinking of that the entire time, because I was the Grim Reaper, 14 years ago, trying to do problem loan workout. And it's probably cost me money over the last decade or so, trying to be a little too conservative. But specifically in the workforce housing space, when I started, we did workforce housing. You buy in, say, Dallas Fort Worth in 2013, when we bought our first deal, you could buy a brand new Class A deal for about a 5 cap. A B deal was about 6.5 cap, and a C deal was somewhere between 8 to 8.5 cap. And this is on tax adjusted trailing numbers. Fast forward to today, I mean, shoot, I don't even know what a Class A cap on trailing numbers is. Probably mid twos, maybe forward year one, buyer pro forma 3.25, 3.5. A B deal trailings probably high twos. Forward buyer pro forma probably upper 3s to 4, and a C deal is probably maybe low threes, and a forward maybe mid 4s forward cap rate. So what used to be a really large spread is all on top of each other. And there should be a higher cap rate on the older, more workforce housing, because there tends to be a little bit more risk, both from a capital perspective, meaning they're older and just functionally obsolescent, so you have more repairs and maintenance and major capital projects. The sewer system, electrical system, and all that stuff is a little bit more likely to wear out on the older stuff, obviously, than a newer building. And then the tenant base and their income level is stretched a lot higher in the older workforce housing stuff than it is the Class A. So there should be a larger spread in between the various property grades, where there has not been for the last several years. And we saw that, and we sold a lot of our workforce housing 5 years ago, not knowing that it was going to get basically on top of each other. We could have held out a little bit longer, but we took that opportunity to kind of trade up, and that's where I see some underlying risk. And if it's been building, that pressure has been building for a while. So if we do see some dislocation and we see some opportunity, I think the Class A, and the nicer, the better the deal, the more sticky the cap rate is going to be. I think on the lower end of the spectrum, that's where the cap rates will widen out, and that potentially can impair your ability to return your money, basically.
Yeah, that's definitely something I've seen as well, right? There's guys that used to be doing B's and C's, have moved upstream, and now their portfolio is their newer portfolio is made of A's, right? Because your point is valid, is that the cap rates are so close. Why in the world would you take all the risk on something that's is going to have problems down the road?
Yeah.
So it's been interesting to watch that from the sidelines, and then also they talk about there being so much dry powder out in the marketplace, and these institutional funds are coming downstream, right? Because they have to put this money to work. And therefore, like what used to be, like they wouldn't touch anything outside of an A, like they've leaked into B's, and then now they're even considered like smaller units and C's. I mean, it's really interesting to see maybe in the past 12 to 18 months, like where the shift has gone, especially with the exodus from office, right? Everybody that used to park their money because like office was as bulletproof as it could be, and then COVID hit, and then it's all of a sudden nobody wants to be in office, right? Multifamily became bulletproof because it was not only the home, but it was also the office, right? So you're kind of getting kind of a double edge there. But I think we're really hinting at it here. But as a limited partner that's getting into the game today, where do you think some of the biggest mistakes that might be made, or mistakes you're seeing people make are?
And I'll answer that question. I don't want to be seen as all bearish. The fundamentals are really strong, as you kind of mentioned. You made me think of rental rate growth is strong for a reason, because there's a lot of household formation that's been pent up, because basically, last year you had two years of graduating classes coming into that workforce and household formation in 2021 at the same time, because when I graduated in May of 2020, basically probably stayed at home, lived with the parents. So that was a big uptick in demand. We saw some dislocation in the ability to deliver supply. And then obviously you've seen the single family market has absolutely been on fire, and price inventories that, dramatically low levels. I mean, probably historically of all time low levels as we enter the peak home buying season. So there's very little alternatives to buy homes right now, and everyone is kind of getting locked in their mortgage now that the interest rates have come up. So people are just going to stay put in their homes and not sell their houses, which drives more people to the rental pool. So these are competing factors to think of. And so to your question, where do you see limited partners make mistakes? I mean, I think most of the success of the deal. I mean, the project matters, the market matters, all that stuff, but your sponsor matters as well. So making sure, in a good environment, sponsor matters less because the market's going to make up for it. And a tougher environment, I think that your sponsor is going to matter, from the standpoint of how do they structure the deal. Are we at 75% leverage? Do I put a 10% pref piece behind it or mezzanine financing behind it to take the actual leverage up to 85%? Am I having, super aggressive rental rate assumptions, having to have everything hit perfect to hit a 14%, 15% internal rate of return and exit in 2 to 3 years? And is that, so if I got a structure like that at a 15% return, or I go look at an alternative structure at maybe 65 levered with no pref behind it to make a 13, on a risk adjusted basis, I think that's where a lot of limited partners kind of see the headline number, maybe don't fully take into factor all the underlying risks to get to those assumptions. And so that's certainly something to think about, how much working capital do you have, behind it? Because, one thing I've learned over doing, I don't know, 60, 70 deals or whatever we've done at this point, every projection I've ever done has always been wrong, right? Either you do better or you do worse. You never do exactly what you think you're going to do. It's just kind of an educated guess going in. And fortunately, we've done well and the market's done even better. So we look smart on a historical perspective, but we've had the wind at our backs, and the wind still is at our backs in a lot of respects with the fundamentals of supply, demand, and rental rate growth. And then, but there's a couple headwinds that we haven't seen here in quite a while that it just makes you want to be a little more cautious and maybe don't over leverage this deal, and maybe take a little bit of risk off along the way, and don't push everything super hard. And it's okay to, I think, deliver a little less expected return, because the alternatives are tough for everyone. I mean, you can go in the bond market, you buy bonds and the rates go up, your bond goes down. You go stock markets at all-time valuations. I mean, I've pulled back a little bit this year, but it's still historically pretty high. I mean, it's a world of bad options. Or if you sit in cash, you're going to have inflation eat it away. So I still think done properly in the right market and structured properly, multifamily is still a very attractive space to be in. I just think you just need to be a little bit more cautious with the sponsor, with the structure, with the market, with the business plan. Everything's not going to, trees don't grow to the sky. So at some point, there's going to be some level of correction. So what I've learned from 14, 15 years ago when we were, 20 years ago, when we're ramping up as a banker, making these loans, and then kind of the aftermath of the Great Recession, and then kind of the last, 12, 13 year boom cycle that we've been in, there's going to be a time, as long as you can hold on long enough, it should go back up. But if you get squeezed out in that 1 or 2 years worth of dislocation, you're going to lose 100% of your money. And so, those that can hang on are, at, infinitely higher valuations and returns. But a lot of people got wiped out and had to make a bad decision, or the bank forced them to make a decision at the bad time. So you don't want to be that person along the way.
You make a really great point in there, and I think it was very subtle, and I want to make it a lot less subtle, is that you're never going to get your projections just right? So if you are a limited partner going to look at a deal, and let's just say we've got two that everything looks very similar, and you've got one that's projecting 14 and you've got another one that's projecting 13, neither one of those are going to be right? Like, that's not the return that you're going to get. It's going to be something different. I mean, there's a possibility that is, but like, it would be, it's like when you stop your gas pump and it's exactly at $20 or something, right? Yeah. And it doesn't mean that the one that's projecting a 13% return is not going to come back with a 15% return, or the one that's projecting a 14% return is not going to come back with a 12% return. Like, that is, the fundamentals of what you're looking at and how they're projecting those returns are what are so important. And to your point you were making, is that you look at the headline, you just say, okay, 14 is better than 13, I'll go with 14. And there is such small, like there's nuances in the deal and the way you're looking at certain things. Like what are you thinking is going to happen with cap rates? Because a very small movement in a cap rate has a very big impact on the value of the deal and the exit. Interest rates, like you got to be conservative there too, but you can play this game, with the exact same property and play the game and move numbers around. And one of them might be everything is doable, but everything has to be perfect for that to work. Whereas you may have somebody else that's like, well, look, I'm going to be a little bit conservative here or maybe over here, and my projections might be a little bit less. But I'm thinking about how this works, right? Because your point is, if you do need to come up with some cash, do you have some cash in reserve to pay for that? Or we're going to be, making capital calls. There's just a lot of little nuances that you shouldn't get overly caught up in the numbers that are published. More so like, okay, how does this waterfall work for me? If the deal does this, right, you're going to do better than your return. If it does less, right, like obviously it's going to be a little bit worse. But I would feel a lot more comfortable, especially in this current market, looking at a deal where I can see there's some conservatism and some flexibility, to withstand some changes, because there will be some changes.
Yeah, that's one thing to take away from my experience is everything's changing always. So whatever today is, tomorrow is a little bit different. And fortunately for the last 12 years, it's been largely positive. If you've been investing in multifamily since 2010, it's kind of the bottom, and then now it's just been a rocket shit straight up. And to your point, little changes in the cap rate have big swing to values, and we've been the beneficiary of that for a really long time. So if they start backing up on us, you can see some value erosion, relatively quickly. Now, obviously, it's a function of NOI divided by cap rate equals your value. And if we're seeing 15, 20% rent growth, and, I think that obviously will make up for a lot of that there if you can just kind of drive the more controllable part of it. So, I think it's just to be cautious and think through and be intentional about who you give your money to. Because, like you said, if they don't have the reserves put in place, there could be a cash call. And in my experience, the goal is always ask for money once and then give a little bit back along the way and a big pot of gold at the end of the rainbow. Trying to ask for money twice is tough, going back to investors, especially if you're in a group with 80 or 100 unrelated limited partners and trying to go herd all those cats and get them to put their 1.2% ownership into the deal of the $200,000 cash call you have. That's tough. And does a sponsor have the ability to backstop that? Can the sponsor put some cash in this deal? If the guy is 4 guys rubbing their nickels together to try to get a deal done, it's a third or fourth deal. That's great. People have to start everywhere, but that's a different risk profile than a well-heeled sponsor with some liquidity backing them that can actually go fund a short-term working capital loan if there's a necessity to do so. And you as a sponsor, maybe you don't see that on paper, but that's something to think about as well. Can the sponsor solve their own problems, or then you go back to the LP group to get that done? And will the LP actually, if the stock market is down 40%, 401k is in shambles, and then you get a cash call for 10 grand, will you actually step up and give a cash call for 10 grand? And not so much you, it's all the other 80 people you don't know in that transaction as well. So yeah, things to think about for sure.
Yeah, I do want to emphasize your point is that it's not all bearish, right? Like this is not all bad news. There's opportunity all over the place, right? The underlying fundamentals, there is a housing shortage. You can't just overbuild overnight. Now you need to be thoughtful about the markets you get into, right? Because there are some markets that have the capacity for new construction, and then there are other markets that don't, right? Like you just can't. Like you've got to build, and you got to build further out, and there'll never be, the benefit of having that good location. And then, too, there's some underlying fundamentals of like a way a deal was structured originally that may get tripped up, right? You were a lender, like covenants are crazy. Sometimes there's covenants that were written that just don't really anticipate the current market. And you start tripping covenants, and all of a sudden the deal has to be restructured or it has to be flipped out. And that doesn't mean that like there's the property's bad or even the deal's bad, but there's an opportunity there. So there's always opportunity. And if you're looking for it and you understand the underlying market fundamentals, you've got a good operator, you've got a good sponsor that's well-grounded in thinking through these things. Even as we go back down, there's opportunity, right? Or if we go back down, sorry, I don't want to say when we go back down, hopefully they do this thing right and it just kind of levels out to a nice plateau and then starts a gentle, incline again, but you never know. But anything else you can think of that we should be watching out for?
Yeah, no, and I think said I'm more optimistic than pessimistic. I think there's the fundamental supply demand demographics that coming at housing for the next decade is just insatiable. So I mean, we still have the wind at our back in a lot of ways. I just say there's some shifting currents, I guess, out there. So just be cautious. I think you need to be more cautious today than probably at any point in recent memory. Obviously, COVID was a big hit, but they just papered right over that. So those are the past sins kind of coming today to be a couple of headwinds. So just be careful and cautious with it. But I think, like I said, ultimately, if done right, 5-10 years from now, I'm pretty confident the real estate is going to be materially higher than it is today. You just don't want to get squeezed along the way and have some temporary dislocation in the marketplace come wipe out your capital in a deal. So properly structuring care and good fundamental markets with population and migration, us business and landlord friendly environments, buying the right location with the right business plan with the right structure. I mean, I think this is among the better risk adjusted returns you can seek out there. So that would be kind of the thing. Just be careful about who you put your money with and the way they're structuring these deals. And I think if you do that right in the long run, this is a fabulous vehicle to put your capital into.
Yeah, I couldn't agree more. I think that's a great way to kind of, segue out here. But the market is going to be strong. Real estate is a great investment. I believe in it. You believe in it. There's a lot of opportunity. There's a lot of people that can go out here and really screw it up. And you just got to be careful who you hit your wagon to. But I always like to close out this show with a bit of gratitude, because none of us got to where we are today without help, somebody giving us a leg up that maybe we didn't deserve. And I just want to give you an opportunity to maybe give a shout out publicly, if you haven't done so already at some point, to somebody that's helped you out, right? And give you.
Yeah, I mean, many people's helped me out along the way, but one comes to mind just off the cuff is, actually the co-host of the podcast I do, which is Old Capital Real Estate Investing Podcast, is a guy named Paul Peoples, who's a very successful and well-known commercial mortgage broker in Texas. And I remember I was a banker. He was my biggest referral source, and I did about 150 loans over a 3-year period coming out of the Great Recession. About 100 of them came through Paul. So he really taught me a lot of kind of the fundamentals of the business and how to kind of get into it, and helped me get really connected along the way. So he's certainly someone that's helped me out a lot professionally and personally. He's a great friend and longtime friend at this point, and a business partner, associate of mine. And without him, I certainly probably wouldn't be in the position where I'm at now. So, he's certainly one of the people that was a key mentor in my success along the way.
I love that. Thank you for sharing. And Paul, I hope you listen to this, because that's a really cool story. Well, Michael, this has been a great conversation. I really appreciate you being here. Thanks for being on the show.
I appreciate it.
I hope you've enjoyed today's episode, and I'd actually love for you to contribute to a future episode. If you have a question you'd like answered, or a topic or a guest to bring on the show, please email me at jake@thelimitedpartner.com. Now, I realize there's a lot of lingo that's thrown around on these shows, so I've created a cheat sheet for you with the top 26 terms that come up most often. Head on over to thelimitedpartner.com/lingo for the list. Enjoy, and we'll see you next time.